I'm Mike, Chief Investment Officer here at Lighthouse Financial Services, and I've got another Mike's Market Update for you. Let's get started. Okay, May 2nd, 2023. Tomorrow's a big day, and I'll tell you why in a couple of minutes. But here's our talking points. Here's the agenda for today. Stock and bond markets still don't agree. I think the bond market's a little more bearish, stock market's a little more bullish. We'll talk about that and the fact that investor sentiment, regardless of whether stocks and bonds, investor sentiment is terrible. So why do we have stocks acting sort of positively? The economy is in slow growth mode, clearly, but we're still not seeing signs of the recession. So a lot of Chicken Little moments where the sky is falling over the last 14 months or so, but the sky is still above our heads. And finally, Fed and the interest rates. As I said, the Fed wraps up their monthly policy meeting tomorrow and will announce the results. We're sort of caught between the Fed and inflation. Inflation has been a little sticky, hasn't come down as fast as the Fed has wanted, and so the Fed keeps talking about raising more. We'll see. Will they pause? That's the big question. Okay, so I talked about investor sentiment just being awful. Here's just one measure of that. The American Association of Individual Investors does this sentiment survey where people vote, and they say, okay, are you bullish, neutral, or bearish about the near-term future in stocks? And you can see that compared to historical averages, we're fairly low. So about 24% of respondents are saying that they're bullish. Now, on the AAII Investor Sentiment Survey website, there is a clear warning in big letters that says this is a contrarian indicator. In other words, the more bearish this gets, the better you can expect the stock market to be in the future. Okay, so keep that in mind. A couple of points here. First of all, yes, most investors are not excited about their opportunities in the stock market in the near term right now. On the other hand, and professional investors know that you want to strike when things are their worst. And so speaking of worst, I want to sort of talk about the other shoe to drop, which is what everybody in the media wants to talk about. So we'll hit that too. Okay, so despite the fact that investor sentiment is terrible, that we all know the risk, we all, listen to the radio, watch TV, read the papers, we know that everyone's afraid of the next shoe to drop, especially after Silicon Valley Bank failed. Now First Republic has sort of been taken over by the feds, and who orchestrated a shotgun wedding with JP Morgan Chase. So we know that there are issues out there, there are risks, and so why aren't stocks lower? Why are we higher than when all this banking stuff came out last month? And I think the simple answer, the price action on the stock market is showing you that investors do not believe that another sort of 2008 style big recession is in the offing. So we'll talk about that too. It is true that the economy is slowing, as I mentioned, and that's the black line. You notice the black line jumps around kind of a lot, and these are quarterly growth figures released by the government. 6.5% on the left-hand side of the chart is way too high. Our economy on average grows about 2% a year. And so in the aftermath of COVID, there was a lot of revenge spending. Everyone wanted to take a vacation. There was a very rapid recovery once we realized that vaccines would save the day and squelch the health crisis. Then the financial crisis was obviated. So massive recovery, and you had huge growth, which gave way to those two negative numbers in the middle. That came on the heels of the Fed starting this rate hike cycle, where the Fed said, look, inflation's out of control, the economy's overheating, job market's overheating, we've got to bring things back into balance. So that's when the Fed started to go to work, raise rates and tough talk the market. And you can see we had a couple of quarters of negative growth, but then something funny happened that no one expected, and that was a pretty good second half of 2022 in terms of economic growth. US did pretty well, but you can see that We got first quarter numbers the other day, 1.1% real, which means that if you don't adjust for inflation, the economy grew about 5%. If you do adjust, the economy only grew about 1%. So it is slowing, and that's one of the reasons for concern, frankly. The job market has started to slow. It's been very, very resilient. But this top chart in the blue shows that the number of open jobs has decreased from about 12 million last summer to 9.6 million. That's still a lot, okay, because we have what, maybe 5.8 million unemployed people in this country and 9.6 million open jobs. So we still have more open jobs than people who can take them. But the good thing is, and the Fed is watching, they're looking at this data. The good thing is that excess is sort of being wrung out. So it's softening a little bit. The bottom chart shows that the number of layoffs has started to increase. You know, to you and I, that doesn't sound good. We don't want more and more layoffs. But the Fed's view is that, look, things got overheated. We have experienced a shortage in labor, and it's a matter of kind of putting things back into balance so that the demand for labor equals or roughly equals the shortage. So anyway, from the Fed's point of view, this is a good thing. In other words, it means that all their work to raise interest rates and slow down the economy is working, and hopefully they don't slow it down too much. Let's check in with corporate earnings because, as you know, publicly traded companies have to report their results every quarter to shareholders, and sometimes they also talk about how they feel about the near-term future, the next quarter, or maybe full year 2023. This chart just focuses on sales growth and profit growth or earnings growth. And so the top is sales growth. You can see that back during 2022, sales growth was very, very high for U.S. companies in aggregate, 10 to 14%. Again, way over the average. So we've slowed with the Fed's help. We're slowing, and you can see in the middle of these charts, both the top and the bottom, that companies are making less money. So sales growth this quarter is down about 4%. Earnings growth or profit growth is actually slightly negative. And so there's a troughing here, this in Q1, and then this quarter, which is Q2. And then analysts are projecting, Wall Street analysts, that is, are projecting a recovery in the back half of the year. Funny that, okay, because that chart doesn't make any sense if you expect a recession to be around the corner in the last half of 2023, okay? So another reason why the stock market might be up is that Wall Street analysts are actually looking at how businesses are doing and saying, well, things really aren't that bad. And I'll give you a quick example of that. This is hard to read, but I'll talk you through it real quick. First quarter beat rate. So to the extent to which companies exceed Wall Street analysts' expectations for sales growth and profit growth, investors are happier. The idea is you report better than expected results, your stock should go up. This past quarter, analysts weren't expecting much of anything because they know that the economy is slowing. Some companies are even still having trouble with cost inflation, but they don't feel like they can keep raising their prices, so their profit margins are suffering. So all this is in investor psyche. But check this out: 79% of all the companies in the S&P 500 that have reported so far have reported a 79% beat rate. In other words, 79% of them have exceeded their profit forecasts, and that's a big deal. That's a fairly high number. And I think analysts coming into and investors coming into this quarter were thinking it's not going to be that great. So results aren't amazing, especially if you look at growth. Again, here growth is slowing, okay, but things are better than we thought. And when you start to price in worst case scenarios in the stock market, like what happened last summer and last fall, and those scenarios don't end up playing out, well, then you have to trade up, and I think that's what happened here. I want to highlight this comment that I found in a BCA research note. The analysts here were looking at bank earnings announcements, and this is what they concluded. We didn't hear anything that inspired us to bring our recession ETA forward from the first half of next year. The big banks are on alert, but the expansion still has legs from what they can glean from their consumer and business customers' actions. In other words, we're not falling off a cliff, and everyone says yet, but the fact is we're not falling off a cliff. So if you look at just look at the big banks and how much your average depositor has in the bank, it is still far more than pre-COVID levels, far more. Consumers still have fairly strong balance sheets. That sort of narrative that we heard last year that all that stimulus money got spent because everybody had to deal with higher inflation for everything from heating to gasoline to groceries. That narrative is not true. So it turns out that consumers are a little more cautious in their spending right now, but they're still spending, and the banks are telling us that they're actually doing pretty well. Corporate and just sort of Main Street balance sheets are fine. All right, so a lot of this talk of recession, we got to delve into this a little bit because I've been hearing this imminent call for recession for about 14 months now. What is the real definition, and are we already in one? NBER is National Bureau of Economic Research, is the organization that sort of has the authority to time and set the dates for recessions. Anyway, this is what they say. They say you need a significant decline in economic activity, okay, that is spread across the economy, not just in one or two parts of it, like housing, manufacturing, trucking, freight, stuff like that, but the whole economy, and it needs to last more than a few months. They say it's typically normally visible, right? You can usually monitor these 5 items and figure out whether you're in a recession: real GDP growth, real personal income, that means adjusted for inflation, unemployment, industrial production, and retail sales. Okay, so how are we doing? I have put the most current growth figures next to each one of these items. Real GDP is still growing. It is slowing, but it's still positive. Real personal income, very, very positive. Unemployment, positive, it's positive because unemployment is very, very low. Industrial production, slowing and barely positive. And then retail sales is pretty good, actually, plus 2.3%. So, and there are different ways to measure that. But I guess the point is that you sort of need to check all these blocks. And these items are correlated, but look, they're not signaling imminent recession yet. So let's talk about the Fed and inflation, because tomorrow, is Fed Day. Inflation is really sort of a work in progress, and I've put 2 measures, 1,000 ways to measure inflation, right? But I put 2 measures of inflation here up on this chart. The black line belongs to the Fed, the New York Federal Reserve Bank's underlying inflation index, and they created this because they said, well, we hear people complain that not enough things are being counted in the CPI, consumer price index. So we want to make a clean version of an inflation index to give a full picture. Okay, well their full picture is that it's plunging and down to 3.6% year over year. So not down to where we need it to be, around 2, says the Fed, but still it's definitely on course. Okay, on the other hand, the blue measure is what they call core personal consumption expenditures index, and this is what the Fed looks at. They look at this and they say it's core because they don't mess around with food and inflation, which tend to jump around a lot. They're looking more at underlying inflation, and they say, well, you look at the blue line, it's kind of sticky. It's not really falling the way we want it to, as fast as we want it to. And so they say, our conclusion is we may have to keep raising interest rates. We may have to keep constricting the financial system. And if they keep doing that, they will run us into a recession. That is a typical pattern from history. So inflation is a work in progress. The question is what gauge you look at, okay, and then what time frame So if you need inflation to come down in the next 2-3 months, forget it, to 2%. It's not going to happen. But if the Fed is a little more patient, like they said last year they would be, in other words, give it a couple years, absolutely we're on the right path, no question, in my mind. Okay, so Fed versus investors. There's another disagreement here. The orange line is the federal funds interest rate. You see stair step rising, and they are expected to raise that rate again tomorrow by 0.25%. And many Fed watchers, many economists think that that might be it. That might be the last rate hike, which would be good. And then the Fed says, well, we'll probably keep that rate at that level, at that high level for a while, just to make sure that inflation comes down. The 2-year Treasury note, however, reflects not the Fed, but investors, bond investors. And the 2-year Treasury note yield is no longer keeping up with that higher stair-step pattern since November. And bond investors are a little bearish. Bond investors are saying, look, we're worried that the Fed's going to go too far. And they're also saying, Fed, you're not going to be able to raise interest rates to 5.25% and then leave it there for an extended period of time. Bond traders, as I see it, really feel like the Fed has that chance to go too far and also might have to cut interest rates pretty soon as growth falls off. So, on the one hand, the Fed says it's good if growth kind of stalls for a little while because that'll stall inflation. So we're looking at that very intently. I want to talk about this idea of a Fed pause real quick, and this came from Forbes Advisor about 2 weeks ago. Until recently, the Federal Reserve was determined to raise interest rates until inflation got much lower. The cooling economy plus the implosion of Silicon Valley Bank, the second largest bank failure in history, has inspired the Fed to start talking about a pause in rate hikes. All right, so and I think I talked about this before, but usually the Fed follows its pattern of constraining financial system, like raising interest rates, slowing demand. In other cycles, this is how it's played out until they break something. In 2008, they broke Bear Stearns, they eventually broke Lehman Brothers, basically broke Countrywide, AIG. So, you have these shocks like the failure of Silicon Valley Bank. The question is, can you contain them, or do they sort of spiral? And I think the answer is that bank liquidity crisis last month was contained because the FDIC, Treasury, and the Fed stepped in and said we're just going to backstop not only all Silicon Valley Bank depositors, but also any depositor in any systemically important bank. So that's all the big ones. And then with First Signature Bank, they just essentially got JP Morgan to buy that bank. So as if it was an acquisition, and no depositors lose their money. So that sort of crisis, I think, is behind us. But you have to wonder, will there be other different unanticipated shocks if the Fed keeps going? So that's the big question. I think tomorrow, this time, we'll know a little bit more than we do today, have a little bit more clarity. But at the moment, we're sort of we're stuck between inflation and the Fed as they fight it out. Stay tuned, and I'll be back early next month to give you an update. Thank you very much for watching.